Today we're going to be talking about my personal favorite house hacking method, buying multifamily properties, living in one unit, and renting out the rest. What's going on, guys? Chris here, co-founder and director of finance and investor relations for Boselli Brothers Real Estate. Today we will be diving into the next installment of our house hacking series and going over one of the most common ways to get started in real estate, and that is residential multifamily properties. Guys, I am really excited about this video. I have used this strategy myself, and I have also witnessed many close friends and colleagues use this strategy to help jumpstart their investing careers. In this video, we are going to do a general recap of house hacking and why it is such a powerful strategy. We are going to answer the question, why multifamily, and outline the 4 key benefits. We are also going to review how to get started, including getting clear on your investing goals and how active or passive you want to be, and then using these factors to determine your specific investing strategy and what type of properties you want to target. We will also give a general overview on crunching numbers. This way you can understand how to even know if you're looking at a good deal or a crappy one, as well as exactly how to evaluate cash flow and determine your max offer price. We will also do a deep dive into financing of residential multifamily properties while using it as a primary residence. This is arguably the most important benefit of this strategy. And finally, we will review some drawbacks and additional considerations of house hacking with multifamily properties and what you can do to minimize the impacts of each one. This is a very information-packed video, guys, because it is one of the most common and achievable investing strategies out there. We wanted to lay everything on the table to show just how possible real estate investing can be and hopefully help you take the leap into your own investing journey and take the next steps toward financial freedom. All right? Let's get into it. First, we wanted to do a recap of house hacking, understanding what it means and why it's important. Housing costs are the single biggest expense for most adults. According to the Bureau of Labor and Statistics, housing accounts for 34% of expenses on average. If you buy a single family residence to live in yourself, you are stuck paying this cost 100%. House hacking is just generally using creative strategies to generate additional income from your primary residence. There are several ways to do this, and we are outlining all the different methods in our house hacking series. In this video, we are going to focus specifically on residential multifamily properties, and that is when you buy a 2 to 4 unit property to live in one unit and rent out the rest. Next, we're going to jump into some key benefits of the multifamily strategy. Residential multifamily properties are one of my favorite ways to invest in real estate because they offer 4 key benefits. First and foremost, it's a very easy way to subsidize your cost of living. As we just mentioned, housing costs are the biggest single expense for most people. With residential multifamily properties, you have an additional 1 to 3 units under one roof and under your single mortgage that can help contribute to this mortgage payment or potentially cover it completely. When calculating returns on residential multifamily properties, especially when you're still living there, a lot of people will factor in this reduced living cost as part of their ROI. It might be tough to cash flow in some higher priced areas when you're still living in the property, but you should definitely not discount the savings you're getting here. There is no golden way to run numbers here, but definitely consider this in your financial analysis. Number 2 is you get to keep 100% of the tax benefits of owning real estate. Since you're the property owner, you get all the tax benefits. If you run your numbers right, the rental income generated can completely cover your mortgage, taxes, and insurance, and even other expenses. And then you get to deduct all of these as operating expenses against the income to help reduce your tax burden. Number 3 is the attractive financing options that this investment class offers. Residential multifamily properties get to take advantage of financing options only available to owner-occupied properties that are acting as the owner's primary residence. Since you are buying a multifamily property and living in one of the units, this will be your primary residence. These loan programs offer lower down payments and competitive interest rates while also having the added benefit of rental income. Now, there are some caveats and specific conditions that need to be met to take advantage of these financing options. We will get into this in much greater detail later in the video, so please stay tuned and watch that section to protect yourself against potential legal liability. And 4, residential multifamily is a great way to jumpstart your investing career without having to do it full time. Between the low money down financing options, some of which will actually give you the ability to roll some renovation costs into these loans, along with reducing housing costs, which is likely your largest personal expense, this is a great way for the average person to get started real estate investing with low costs upfront. In addition, being so close to your rental units will allow you to save extra money by self-managing your property if that's something you want to do. Disclaimer, this is not for everyone. Self-managing your properties come with their own drawbacks and risks, and you really need to understand tenant rights along with local rules and regulations to avoid potential legal concerns that could cripple you long term. This is also a much more active form of investing, so make sure that this fits in with your long-term goals. Another way this strategy can help jumpstart your investing career is that it is a great way to learn the ins and outs of some various aspects of the real estate investing business. Whether you decide to self-manage or not, you will get great exposure to all different aspects that make up a successful real estate investment. And finally, all of that extra income generated from those rental units will help you save up money fast faster. Once you have enough saved up, you can move out, replace yourself with a tenant in the first property, and buy another one to repeat the process. You can repeat this snowball method as quickly as your risk tolerance allows to multiply your streams of passive income and start creating true generational wealth. So, by now you might be sold on why multifamily house hacking is a great idea. But you're probably thinking, okay, Chris, that's great and all, but I still have no idea how to get started. So let's take it step by step. Before you even start looking at deals or talking to agents about seeing potential properties, you need to establish clear buying criteria. The more specific you are here, the better. We actually have an entirely separate video we're going to link right here that goes into this topic in a lot more depth, so we're going to keep this pretty high level. But the main things you need to do are have an honest conversation with yourself or with yourself and your partner to assess your long-term goals and financial situation. You will also need to assess your desired level of involvement in these investments, aka how active or passive you want these investments to be for you. Then you need to use these specific factors to choose your investing strategy and specific types of property you will buy. That includes things like, are you going to do value add or turnkey? We already decided on multifamily, but are you going to do duplex, triplex, 4-unit buildings? Do you prefer side-by-side townhouse style units, or do you want one of those triple deckers in Southie? Again, the more specific you can be here, the better. Narrow your focus so you're not overwhelmed, and as you start looking at the same types of deals over and over again, you're going to become an expert a lot faster. Next, let's get into running the numbers. So let's fast forward here, and at this point, we're going to assume you've already sat down and established your specific buying criteria. You've established your goals, talked about your financial situation, picked a target strategy, and aligned on what property types you are going to consider. Now the question is, now that you're starting to get leads in, how do you know what's a good deal and what is a potential nightmare? The first thing you need to know is how to determine a property's after repair value, or ARV. Again, guys, we actually have another full-length video we're going to link right here again that Ryan went through in great detail on exactly the factors you need to look at when determining after repair value of your property. So we'll keep this one a little more high level, but definitely go check out that video for more specific information. Generally speaking, there are two main ways to determine a property's ARV. First, get a CMA from your agent. This is a comparative market analysis where they will go through and look at recent sales to tell you exactly what your property will be worth. They will print you out an entire list of recently sold properties that are similar in size, condition, and age, and are all in the same direct proximity to the houses you will be looking at. And two, you're going to want to do some research yourself. Not that you shouldn't trust your agent, but it's always good to trust but verify and run your own numbers here. You're going to want to look at this from a property value standpoint and a potential rent standpoint, especially if you plan on making repairs. Again, work with an agent and some property managers, as they will be your local market experts. And guys, get multiple opinions. If you're working with a single agent, that's great, but that's why you also need to run the numbers yourself. Trust but verify. If you're interviewing potential property managers, use multiple companies, and in the process, ask them what type of rent premiums they think you could see in that area. After you know the ARV on both the property value and potential rent, you need to know how to analyze individual deals and calculate your offer price. Again, common theme here, we have another full video dedicated to this entire topic, but in the interest of keeping this video to under an hour, we're going to keep this pretty high level again. What you really need to know is how to analyze for cash flow. At a high level, cash flow simply is income, aka rent and any other revenue generated by the property, whether it's renting out parking spaces, extra storage space, etc., minus expenses such as mortgage, taxes, insurance, utilities if they're not separated in the home, and any other normal operating expenses, minus a percentage of gross rents that you will dedicate to future expenses and capex items. A lot of people forget this one, and it will make every deal seem a lot more enticing than it really is. Guys, you will always have little items pop up over the course of the project every single year, and if you don't plan for them, they can wipe out any projected cash flows that you might have. You can factor in anywhere from 10 to 30% of gross rents for this repair cushion. It depends largely on property age, condition, and what repairs or upgrades have already been done. Be a little bit more conservative here to start, and anything left over at the end of the year is just extra profit. When analyzing cash flow on a potential deal, you're going to want to look at it through two specific lenses. First is while you are still living in the property and covering a portion yourself. In most situations, especially in more expensive markets, your property may not actually cash flow while you're still living in it. The exceptions might be some very high rent to price ratio areas, or if you have a 3 or 4 unit property. However, do not forget that you are reducing your living costs in the process. So if you would otherwise be paying $2,000 or $3,000 for rent and you only have to pay $1,000 to live in this with the help of the other tenants to cover your mortgage, that's an extra $1,000 to $2,000 that you are also saving. This will affect your overall finances for yourself or your family, so definitely consider this when calculating your return on investment. The second lens you're going to want to look through is after you move out and every unit is rented by paying tenants. The ultimate goal is that you want to turn this into a fully cash flowing rental property, so you're going to want to make sure the numbers work and align with your overall goals and dollars per door metrics. A pro tip here, guys, is we always run our numbers with the idea of having professional management in place on the back end. That's just our strategy. We want these to be more passive streams of income for us, and we do not want to deal with managing our own properties. You're going to want to factor in property management fees, like the actual management fee, which is typically 6 to 12% of gross rents, 8 to 10 being the most common, leasing fees, advertising fees, etc. Talk to a few local property managers to get an idea of what some of these fees could be. So now you've found a deal that meets all your criteria. How are you going to finance it? As we mentioned before, one of the biggest benefits of multifamily house hacking is the financing and loan programs available to you as an owner-occupier of that property. Because you will live in one of the units and it will act as your primary residence, that opens up all of these financing options to you. There are several government-backed lending agencies that offer low-cost competitive loan products to owner-occupant home buyers. Two of these you've probably heard of are Fannie Mae and Freddie Mac. These loan programs offer down payments as low as 3 to 5% or $15,000 to $25,000 on a $500,000 home purchase. And they also offer very competitive interest rates with no additional penalties despite it being a multi-unit property. Some of these loan programs even allow you to roll renovation costs into the cost of the loan. This is a great benefit because it means you have a lot lower upfront cost of the renovation. It's that same 3 to 5% down on the loan, as well as lower interest rates and longer terms than your traditional home renovation loans. Trust me, you cannot find renovation loans that are amortized over 30 years anywhere else. Now, usually, regular investment properties do not qualify for these loans. Loans for multifamily properties that you do not intend to occupy as your primary residence for at least 12 months at the time of purchase typically require a much higher down payment, usually 20 to 30% down, higher interest rates, typically an extra 1% or more on top of your regular 30-year fixed rates, and have higher requirements for key metrics like debt to income ratio, debt service coverage ratio, and credit score, which are all metrics you need to meet to be approved for the loan. However, since you will be physically living in one of the units, that makes this home your primary residence, which opens up all of those owner-occupant home loan options. There are some important stipulations to note here. You do need to intend to occupy the property for at least 1 year at the time of purchase. Another consideration is that since you will be putting less than 20% down, you will have private mortgage insurance or PMI. This is an additional cost on your monthly payment, typically a couple $100 depending on the size of the loan, your credit score, and all those other factors. And this will stay on your monthly payments until you reach 20% equity. Another consideration is that there are usually caps on the maximum purchase price that you can do for these loans. This cap amount usually depends on the number of units in the property and the county which it's located in. A licensed mortgage broker should be able to provide these details in your specific area. These cap prices usually only come into play in higher priced areas, but it's something worth considering. So now that we've covered all of the various benefits of multifamily, let's go over some of the cons. While residential multifamily is one of the best ways for the average person to get started real estate investing, this strategy does not come without its own set of drawbacks and considerations. Number one is reduced privacy. Buying a multifamily property means you are now sharing your primary residence, yard, driveway, and probably other things with complete strangers. Newsflash, most walls are not very soundproof, so be prepared to hear things like common family arguments, your neighbor's children learning to play an instrument for the first time, and potentially intimate moments. Pro tip, take a look at your unit layouts and choose your master bedroom location carefully. Another potential drawback is that you may have difficulty separating business and personal matters. Living in such close proximity to your tenants blurs the line between professional and personal relationships. It can be challenging for some to establish the boundary between being the friendly neighbor and the guy that has to come and collect the rent every month. Next is legal and regulatory considerations. Being a landlord comes with its own set of responsibilities and obligations. You need to understand your local rules and regulations to ensure compliance and avoid potential legal issues that could cripple you long term. This is another reason we always advocate for using professional property management companies, as this can help you protect yourself and your investments. Another drawback is there is a limit to the number of times you can repeat this strategy. There actually is a limit on the number of personal mortgages you can have in your name. Technically, this number is 10, but after 4, this gets very challenging to do. There are some loopholes or ways around this, like if you're investing with a spouse, you can each have 4 properties in your own individual names, but you are still limited overall on how many deals you can do this way. This is not intended to be a long-term strategy, but it will allow you to gain the experience necessary and the track record you need to start looking at other means of investing. Despite these challenges, most investors find that the benefits of house hacking through multifamily outweigh the drawbacks. By carefully considering and preparing for these challenges, implementing effective property management strategies, and maintaining open communication lines with tenants, it is possible to navigate these potential downsides and create a successful house hacking experience. That was a lot of information for one video, guys. So to summarize and wrap everything up, in this video we discussed how house hacking through residential multifamily properties is one of the most common and one of the best ways for the average person to get started in real estate investing. We also reviewed several key benefits of multifamily investing, including the ability to subsidize housing costs, lucrative financing options available to you as an owner-occupant in this property, and how this is a great way to jumpstart your real estate investing career. We also went over how to get started. To do so, you first need to get clear on your investing goals and whether you want to be active or passive in this investment journey. Then use these factors to narrow down your specific investment strategy and the properties you're going to consider. When reviewing these potential deals, do not discount the savings you will get from reducing your housing costs. Crunch the numbers on what the cash flow will look like while you're living there and after you move out and replace yourself with a long-term tenant. Always run the numbers with professional management in place. This way, you are not handcuffed by the inability to offload this part of your investment. That way, you are not handcuffed by needing to manage the property yourself to ensure cash flows. And finally, we went over the financing options available to you as a residential multifamily investor and how this is one of the most crucial benefits available to you with this strategy. We also talked about some drawbacks and considerations of this strategy and some different things you can do to minimize the impact of each. And that's going to do it for this video, guys. Be sure to like, comment, subscribe, smash that notification button. Check out our website and subscribe to our newsletter for current events, market trends, and all things real estate. As always, guys, our content is 100% free, so please try to help us reach as many people as possible so we can help others avoid the mistakes that we have made along the way. Again, I'm Chris from Boselli Brothers Real Estate. We'll see you next time. I did the quick look.
A little higher on your hands. Here. Lower. Right there.
It meets the criteria. Go, go!